Welcome to episode 7 of Bitcoin and Blockchain for Beginners. Today we're talking about blockchain scalability and privacy solutions. I'm Ryan Harper. With me is Mike Llewellyn, who is the brains behind all this. And I am just your advocate of, hey, I don't know what's going on. And to be honest, it's been a minute since we've done one of these, and I haven't kept up with the education of Bitcoin and blockchain. So if I ask stupid questions, that's what I'm here for.
Ready to get started. So yep, I've been busy working at OpenZeppelin. We've been going through a lot of changes lately, so I appreciate the patience and glad to be back.
Yeah.
Also, OpenZeppelin is now a member of the TBC. That technically wasn't a thing before, even though I was here, but now it's official. So
amazing.
I do have to say, OpenZeppelin, great security company, by the way. Since they're a member now, I'm obligated to do that. So, but today we're not going to really talk about that specifically as much as just generally what are some scalability and privacy solutions that are really blockchains are needing to get for full adoption, because we have big expectations for blockchain, but that requires a lot of users and potentially a lot of use cases that need high throughput and some privacy.
So before we get too much into it, when we're saying scalability, are we talking about scalability in the user cases, scalability in the infrastructure? Like what are we talking about scalability here?
All right, well, let's do the first slide, so that we'll get right into the definitions here.
Oh.
So scalability, when we're talking about blockchains, are usually transactions per second. So really, like, how many transactions can we push through this thing and get the result? So Bitcoin transactions, can I send money to someone? In the case of Bitcoin, you're usually not going higher than 6 to 12 transactions per second. If we went higher than that, then we turn into a case where we have to get bigger blocks, and those bigger blocks require bigger nodes, and then we could become less decentralized or more centralized.
But wasn't that the whole reason of Ethereum, is because Bitcoin had a limited amount of transactions per second, so Ethereum redid everything so it could do more?
Not exactly. It was actually more about smart contracts, more about we want to process more smart, like really just support more use cases, but it still borrowed a lot of the same blockchain structure that Bitcoin had. So while it's a little bit faster because it has faster block times, it's actually still like not really doing more than 25 transactions per second at most. So this applies to both Bitcoin and Ethereum when we're talking about these scalability challenges.
Okay.
And so again, really the core of this is, and this is actually a trilemma that Vitalik came up with when he described the scaling solutions for Ethereum, is, okay, we have these great properties of decentralization and security. Decentralization being anyone can run a node, anyone can validate it, we have a large node count. And then security being, no one can break the thing. No one can reverse transactions after they've been confirmed. I can trust that the system is going to be around for a long time. But when we introduce scalability, we typically see that it requires some sort of a trade-off with decentralization or security. Well, I want to run more transactions. Well, maybe you need bigger nodes to process them, and that starts to weigh in on decentralization. And if you try to cut corners to say, well, I want to be able to run those nodes in a smaller capacity, you might introduce complexity that reduces security. So usually you end up talking about these trade-offs, and so the trilemma is, can we try to get all three? Is there a world where my blockchain can be decentralized, secure, and still scale to thousands of transactions that might be necessary if we're talking about this being like the new world platform for processing any sort of transaction, whether it's payments or smart contracts. So the other thing is just privacy. So this is an important thing that comes out a lot because everything on the blockchain is public, whether it's Bitcoin or Ethereum. If I'm sending a Bitcoin payment to you, you can look at my wallet and you could potentially see other transactions that I've sent to other people. So I guess you can think of it like Venmo in a sense, except people aren't always as aware of the fact that what they're doing is potentially public knowledge. Sometimes it's a good thing because you can see cases of potential fraud occurring or criminal activity. So like we've actually been able to track down stolen Bitcoin, like Bitcoin stolen from Bitfinex, for example. We were able to track down the people laundering that money years after the fact because authorities were able to track down the transactions.
Well, we talked about that on previous episodes about how there was this seediness, this perception of seediness around Bitcoin blockchain, but the reality is a lot of the authorities were able to catch the people that are doing illegal activities because it is so public.
Yep.
But it was almost like, did the government purposely put out this narrative that it's like it's secret, so therefore use it, and that way it's so much easier to catch them?
It's an interesting theory. I would say, I think most of it came from people just getting caught up on, oh, well, no one knows my account, therefore I'm private. But in reality, as soon as you make a purchase on Amazon using that account, well, Amazon knows who you are, and anyone who talks to Amazon gets that identity from them, knows,
Right.
and so eventually you're going to leave breadcrumbs that are there forever. So that's really the problem. And so, I mean, yeah, that's good for being able to like have transparency around criminality and stuff like that. But when it comes to an individual user, like I don't want people to know I'm using Bitcoin to buy things that are important for me, that might have something to do with my personal security. Maybe I'm trying to buy a firearm and I don't want people to be able to associate me to that firearm for perfectly legal reasons.
Right.
Just my privacy and having protection around my data.
Well, I think that's a huge distinction with like the Bitcoin crypto crowd versus, say, pretty much any other group of people in the United States, which is like if I'm a real estate investor and I'm doing really well, I want everyone to do I'm doing really well. I got my Lambo, I've got my Rolex, got my whatever. But a lot of the crypto guys, like, they don't want anybody to know how well they're doing.
Yeah, and I think some of it's personal security. Like, if I have this much money, then you might try to, and we're talking about millions, maybe billions, people start to get kidnapped and held for ransom. Like, that's been a fear in the past. But just generally speaking, like, why would you want to put that data out there as a start?
Yeah.
So, I mean, it gets to a lot of privacy concerns. And so and not just for consumers, but businesses. Like, if I'm a business and I want to do activity with some of my partners, I don't want all of our competitors to know what we're up to.
Yeah.
So there's a lot of concerns that come up with that, and there are solutions to it. We'll talk about that today. And then I also throw some other adoption challenges in here. We're not going to talk about them in detail, but user experience, how I actually interact with a blockchain securely and safely, how I manage my keys, and then just generally regulatory uncertainty, which certainly hits home here at the Texas Blockchain Council. So with that, we can get right into some of the solutions that we're talking about. We'll start with the favorite for many Bitcoiners, which is the Lightning Network, otherwise known as just a payment channel, as the more technical term for it.
Mm-hmm.
So this has gotten a lot of traction in the Bitcoin community. It's also been tried in Ethereum with Plasma, but really I think Bitcoin is where you're seeing the most, we've gotten the most advanced solutions with Lightning in Bitcoin. So the idea is, hey, we have all these transactions on chain, and in the case of Bitcoin, we don't want to change Bitcoin too much because we want it to be very stable. We want it to focus on, preserving a 21 million supply cap guarantee. We want to ensure anyone can run a node. So we have to look for things outside of the protocol itself to scale. And the idea for Lightning is, well, let's take a lot of these transactions that we might need to process to send Bitcoin from one person to another and bring them entirely off-chain. But we want to preserve that security around a transaction, knowing that that is a guarantee, knowing that when I send that payment to you, you can trust that it's secure based on the technology, not on some counterparty risk. So really the way that payment channels try to achieve that is they use on-chain multi-sig escrows. So in very simple terms, what that means is it's a wallet that is controlled by more than one key. I think we talked about multi-sigs in the past, and really, when it comes down to it, it's just, hey, okay, if we decide to open up a multi-sig, you have a key, I have a key, and then we both have to sign to move the funds. So the idea is like, okay, we're putting it in a shared vault we both control. And
but in that shared vault, you both control it. Does that mean you both have to agree to be able to do something, or can one or the other make decisions?
So good question. You could customize it however you want, potentially. But the way we typically do it in the escrow for Lightning is we both control it to do an immediate exit. But if one of us wants to exit, then we have to put up proof that when we pull our money out, we have honored the agreement that we've set up. And that's where the payment channel comes in. Because basically the idea is, okay, you've got 10 Bitcoin, I've got 10 Bitcoin. Apparently we're doing quite well. We put that into a payment channel, and let's say, every time I show up, I'm going to buy you a cup of coffee. Or maybe I bring you a cup of coffee and you're going to pay me each day when we're doing these videos. With this payment channel, because we put that money up and we've locked it up essentially on Bitcoin, on the protocol, we can now open up a channel off-chain using Lightning to now send payments to each other as small commitments. So these are still transactions. that we're signing with a private key that each of us control. So, okay, I've brought you some coffee. You'll send me a message and you'll sign it and say, I'll pay you $5 worth of Bitcoin, based on its value today. And we're just going to keep doing this back and forth. It's like a line of credit. All right, every time that we do a small thing, I'll send you a payment. And we both will keep copies of these payments. We'll both have that record. And every time we're signing a commitment to one another, it kind of is the new version. So I send you a payment. That is now the new summarized version of all the payments we've had before. They're all linked together. And the idea here is that at any point, either one of us could decide, you know what, I'm going to leave this channel, and I'm going to take the sum of all of our payments and sum it down to one transaction. So if we've been sending money back and forth, but in the end, you've sent me the equivalent of 5 Bitcoin, I've sent you the equivalent of 3 Bitcoin, then the net result would be I take 2 Bitcoin out of this net total that we have. And so with this payment channel, I can initiate an exit, and you can either agree and say, yes, we'll exit, or we'll have a period of 7 days where you can contest that and say, hey, you didn't include this payment that I sent you earlier because I'm trying to potentially cheat. You could contest that, put up your transactions, and the Bitcoin chain can look at these transactions and say, yes, you're more valid based on the signatures and the timestamps and these other things.
So in this situation, and on this Lightning node, this Lightning network, now is it separate from the worldwide Bitcoin network and blockchain, or is it consistently updating every time I guess what I'm asking is it updating real time, or is it waiting till the full thing's done and then does it upload all that data to blockchain, or is it only updating the blockchain with the final results?
Gotcha. So
does that make sense, the question?
Yes, that makes sense. So the way that this works in terms of a node structure is you have your Bitcoin node, and then alongside it you would have your Lightning node. Mm-hmm. And the Lightning node is in charge of managing this payment channel we've set up between each other. And it's going to watch on the Bitcoin chain to make sure that money is sitting in the vault and it's doing fine. But it's not going to update the main Bitcoin chain as we're doing these payments, because what's going to because we're going to try to keep as many of these transactions off chain as possible, because this is a lot cheaper. Bitcoin fees can cost
the gas fees.
Yeah, well, in the case of Bitcoin, it's not even called gas, but you still have a transaction fee.
See what I know.
Yeah. So a Bitcoiner would be very offended if you attribute it to Ethereum gas, right?
I thought it was all the same stuff.
Yeah. But it's similar, and that is still the problem. Is it's a high transaction fee, and the more transactions that people are trying to put through the Bitcoin blockchain, the more it's going to cost per transaction. So the more we have off chain, the cheaper it is, and that's great. Because Lightning transactions are very cheap to almost nothing. So we can send these transactions back and forth, use this channel, and then only when one of us wants to move our money out of the channel on the Bitcoin blockchain, on the main chain, do we actually have to essentially initiate an exit, take the data that is stored on our Lightning node in terms of all the payments, and then send that to the Bitcoin chain in one transaction, just saying, hey, here's the net result of all of our payments, and give me my money. And again, we can contest this potentially. There might be some disagreements between us, but because that data was still signed with cryptographic signatures, we can validate it without any human intervention. It can be entirely handled by the Bitcoin system that was set up on chain.
Now, are these all smart contracts, or is this is a company doing, how would one do this?
Gotcha. So there are Lightning nodes that are set up today, and you can use that software. There are also other companies that are building on top of that. Some of them are TBC members. I think I know that Tremble Ventures has a lot of companies in their portfolio that are working on this. And basically we have the open source software that's available, the Lightning Network, which is available as a node package. And then there are people that have built applications on top. Strike, for example, has built a lot of work on the Lightning wallet, their own Lightning wallet, and Moon, M-U-U-N, is also in one version I use. Some of it's self-hosted, where I self-host my own Lightning node. Some of it is I let someone else host the node, but I use it for payments. There's a lot of different options, but in the end, the idea is these payments are cheaper, they are faster, and they're not going to clog up the Bitcoin blockchain. So, and then there's even ways where it gets very complicated, so I'm not going to get into it here, but there are ways where not just channels that you've opened between you and me, but we could actually do multi-party channel flows, where we have multiple channels that move funds between each other without having to do exits or entering on the main Bitcoin chain to make it even more efficient. So there's a lot of advantages to this. It's really, I think, the main focus for Bitcoin's scale. Lightning is really like where you see a lot of people focusing development efforts. But there are some downsides that people need to be aware of. You're not getting the same experience you might get on the Bitcoin chain, although it's very close. One of the biggest things is you still need open and closed channels here and there. That multi-party flow does improve this, but those are still transactions occurring on chain. And so there's a little bit of scale. And I know that the Lightning paper initially estimated that if we got 40 million users on the Bitcoin chain using Lightning, we would still hit our scalability limit at 40 million. Because let's say they do 2 to 3 exits per year, that's still enough that when we're hitting 40 million, we still have some scaling issues. So it doesn't fully solve the scalability problem, but it pushes it way off into the future. And in general, there are also ways to optimize it and make it easier to squeeze the most out of the Lightning network.
But do you think, and I'm not going to pretend to understand anything you just said, but pushing stuff to the future, like if you're saying the limit's 40 million, and you said way in the future, well, I'm assuming at the rate of technology is increasing, like we probably won't even get to that point when there's maybe a new system or a new Lightning or a new type of technology that helps, that makes it even faster and more efficient.
Well, yeah, and I'm quoting that from the 2017 Lightning paper, which was based on a very simple form of Lightning. Today, with that multi-party flow, there is probably a lot more. I don't know what the number would be, but we're likely talking about more than 40 million that we could support on Lightning and Bitcoin today without hitting any scalability issues. So it's just a question. The technology will likely improve. That is just to say there's still activity happening on chain, and the Bitcoin chain itself is still somewhat limited in its transactions, but a Lightning can really, really increase that capacity. And then the other thing is just you have the requirement that participants must hold their own payment data. So when we're sending those transactions back and forth, we've got to keep those copies in our Lightning node or in some Lightning node someone's running for us. So we have to trust someone to run the node. And if you try to initiate an exit from this channel without including the latest payments, I need to be able to submit my payments on chain to contest that, to say, no, he owes me these payments he didn't include. And if I don't have that data, if my node goes down or I lose that data or I just am not paying attention, then you could potentially leave that channel with funds that are rightly owed to me.
Because one of the things I'm hearing, and again, if I'm way off, just let me know. The whole point of a decentralized anything with like Bitcoin is the only way to hack it is if you own 51% of all the nodes, all the miners out there. So if there's a singular node, doesn't that negate that? Because now that node could potentially be hacked or the data corrupted or data changed to where you could steal? Just exactly what you're saying?
It does increase some of the security risk in that sense. Now it's mitigated by, you can have watchtowers that are set up that watch for fraudulent exits. You can trust other providers to have backups of your node. There's a lot of things you can do to protect against that, but it's just to know that there's more risk on just that Lightning node to operate properly. And that's, again, I think that's something that's perfectly valid for a lot of payment use cases, and we'll likely see a lot of Lightning nodes be set up not by individuals, but by merchant payments. The one thing to note is just with Lightning, it's not just your key that owns your crypto, it's also the payment data that can be used to redeem it on the Bitcoin chain. And that's just a risk that you have going up front, but again, it can be mitigated quite a bit by having good Lightning solutions, open source software that you use, and good custodians and services, many of which are, again, working in Texas and trying to make this technology easier.
A good consultant to make sure everything's in,
Not me, honestly. Like there are far smarter people working on Lightning than me.
I don't believe it.
Well, I don't work on Lightning. I work more on Ethereum stuff. That's why I say that. There's someone who knows more about Lightning could go into more detail, but this is my understanding of it. And again, the final thing, and the reason I don't work on this as much because I'm kind of a smart contract guy, is Lightning doesn't support smart contracts, or at least not the same sort of smart contracts we would expect for Ethereum. Not the sort of, oh, it has the full security of the mainnet. There are some Lightning apps that people are working on, but we're typically not talking about them using the full security of Bitcoin. They're usually they're usually more dependent on, again, those Lightning nodes for their security, which could be good for that use case. So again, that's the real limitation is, we're not talking about smart contracts, we're talking about payments for the most part. The next scaling solution that we can talk about does talk about smart contracts, which is sidechains. So this is an idea of, okay, well, we do want greater scalability and flexibility for smart contracts. In the case of Bitcoin, we don't have native smart contract support on Bitcoin, or at least it's very difficult to write smart contract use cases. You can do some escrows, you can do some time locks. There are people working on ways to expand that functionality in Bitcoin, but for the most part, we're not seeing a lot of that on the main chain because it's made for payments and payments only, and that's how it was built. But the idea is that, well, maybe you can borrow the security of Bitcoin and place it on the smart contracts on a sidechain. This is something that Blockstream, which is a really big Bitcoin-focused company, has been working on for many years. This is, I think, actually based on their diagram. And they were like, well, we can bring smart contracts to Bitcoin by running a blockchain that has that capability alongside Bitcoin, and then use a two-way peg to kind of anchor it to Bitcoin, to try to borrow as much of Bitcoin security as it can, and let people move their Bitcoin into the sidechain and then do smart contracts with that. So this has had a lot of hype in the beginning. We've also seen solutions on Ethereum like Polygon do the same approach. Even though mainnet Ethereum has smart contracts, they are expensive to use with gas fees. So Polygon offered a way to do that with a lot lower fees. However, this also comes with some disadvantages, and this is mainly on the security and decentralization side, because even though you can anchor and potentially do things like say, I'll hash all the data on my sidechain and place it on Bitcoin so that if I ever try to invalidate the data on the sidechain, I've cheated. But there's still some issues with custody of funds. You're typically trusting a smaller network of nodes that run the sidechain to act honestly. So Bitcoin has 10,000 plus full nodes running that help to provide security, as well as all the miners that provide security around ordering blocks. That's a lot of, that's a massive amount of resource to protect Bitcoin. With the sidechain, it usually is coming down to only a small number of nodes, like maybe 100, maybe 20, maybe a couple. It depends on the sidechain. But if we're talking about like a simple majority of those nodes that can decide what to do, then it only takes potentially 10 or 15 or whatever a majority of those node counts are to potentially take people's funds. Because the way it typically works is you can kind of think of it like a bank deposit, where I take my Bitcoin, I place it in a multi-sig that's likely controlled by the validators of that sidechain. They'll have a bridge, they'll listen to it, they'll move those Bitcoins and kind of replicate them on the sidechain, so you can move it around as if it was actual Bitcoin. You can put it in a smart contract. You could use it to buy other tokens that might be on that sidechain. But the Bitcoins that we see as the main source are still sitting on the Bitcoin chain in that multi-sig, kind of locked up in escrow as they're being used on the sidechain. So at any point, the sidechain could decide by a majority of validators or whoever controls that bridge, hey, we'll just pull the funds out and then run away. And we've had many bridge hacks that have occurred on Ethereum and some on Bitcoin that have shown that that is an attack vector we have to be very concerned about.
So stepping back just a little bit, because I know we try to keep these conversations very generic. When we're talking about that situation with the payment channel where it's just you and me, is there a limit to how many people are in that payment channel?
I don't think so. I think you can build multi-party payment channels in addition to multi-party flows. So I guess what's the angle you've got with that question?
Well, the only angle I was just thinking about is could you have 100 people on this thing? Could you have 1,000?
Potentially.
Yeah,
and in the case of a sidechain.
But I understand the follow-up question to that is why would you do that? But I mean, I don't know why you would do the payment channel in the first place, other than the speed and all that.
Yeah.
Because unless you're if you're doing a lot of stuff with the same person over and over and over, but in my life, I don't really do anything with the same person over and over enough that I would set up a payment channel like that. But that's just me and my own.
Yeah, and it's important. It is important to know that Lightning channels can flow through multiple channels. You can have multi-party flows to reduce the need to open very specific channels with specific people. And so again, people that know more about Lightning can expand on that. But I guess coming back to a sidechain, that multi-sig escrow that controls the bridge between the two can really only be someone who's running both a node on Bitcoin or whatever parent chain. It could also be Ethereum, and then on that sidechain. So they're running nodes on both, and they're acting as the bridge between them. So whenever they see something happen on Bitcoin, like someone deposits Bitcoin saying, I'd like to move to the sidechain, please, they see that and they signal on the sidechain, oh, and they will likely sign something with their key, oh, this can be approved. And they might have a network of validators doing that work, but it's not going to be a majority of the participants on that network. It's likely going to be a small number that could be potentially compromised, either by the security of the bridge being compromised or by the validators themselves being malicious or deciding to run off the money. And so that's the real risk. And then finally, it's just there's compatibility issues. It's the fact that if you have multiple sidechains running, well, how do those sidechains talk to each other? It's going to be really difficult to agree on a common set of standards, especially on Bitcoin where there's not a smart contract framework. Sidechains could implement their own, but one sidechain might be slightly different than the other. There's, for example, Rootstock, which is a sidechain built on built on Bitcoin for running Ethereum smart contracts. And then there's another one called Stacks, which doesn't even call itself a sidechain, but I would consider it a form of sidechain based on how I've researched it. And it is also running a very different smart contract language. And then Liquid is doing something different. So there's how would they speak to each other? It's kind of actually very difficult. And we're likely not going to see a world where there's just one sidechain, because then that sidechain would have trouble scaling because it's now probably processing too many transactions.
As far as the sidechains go, I'm reading this slide. A sidechain is a separate blockchain network with its own set of nodes that connects to another blockchain.
Mm-hmm.
I'm trying to formulate a question here, just because I think I get it, but at the same time, it's what's the point? I mean, other than hey, you're trying to speed stuff up, but if the whole point about having the security of one of these bigger, a Bitcoin or Ethereum, doesn't moving to a sidechain just kind of negate all that security?
Yep, that I think is the core issue with sidechains. And that
so I actually had a smart
yes
take.
Yeah.
Okay.
Yep.
All right, we can cut the episode. I had one smart moment. Got it.
Yeah, and it's important to know a lot of the sidechain projects are aware of this problem, and they're basically trying to come up with solutions to properly pull in the security of Bitcoin or another parent blockchain and claim that they are at that level. But I would disagree with all the claims I've seen of that, as in none of them seem to have reached that point today. None of them really seem to have it. And I think it's just it's a core design issue because it's still fundamentally separate from the main blockchain.
Well, because in a lot of ways, to me, give me some rope on this. It's similar to because I did a Bitcoin Brew this morning with Amy. Which is another show here on Texas Blockchain Council YouTube page. But she was talking about how there's 4,000 Bitcoin ATMs in Texas alone. Out of 35,000 globally, 4,000 are in Texas. But the problem they have is there's some of them malfunction and you just lose your stuff. And to me, it's if I'm looking at that, why would you risk it just for the ease of being able to do it? So the reason I'm bringing this up for the sidechain is okay, if the whole point of this is for the speed and the ease, but yet there's a major risk, I'd rather give up some speed and have a little bit more hassle and have less risk.
So it's a good question. I think in the end, it starts to depend on your use case. So. Yeah. I can actually speak for Open Zeppelin. We actually, or at the very least, we work with companies that are using sidechains like Polygon. And again, the intent is it's just much cheaper and much faster. Mm-hmm. And they realize there's a risk. They're trusting roughly 100 validators on Polygon to act honestly.
So I thought Polygon was, and again, I'm an idiot, but I thought Polygon was like an altcoin.
I mean, it kind of is in the sense that it does have its own cryptocurrency and you use that to pay fees on that sidechain, but it is tethered explicitly to Ethereum. It posts blocks to Ethereum to say, we're trying to at least borrow some security from Ethereum, even if it's not all, and they have a bridge to Ethereum.
See, and so I guess this is opening up a whole new doorway, at least to my understanding of the blockchain technology, because every time I heard of altcoins or shitcoins or whatever you want to say, I'm thinking they're all these different little things that are all separate, and in some magic land, you can exchange one for the other. And what I'm seeing with the sidechain, it's almost like, hey, you've got the gorilla, and this is the little backpack on the gorilla or something. I don't know what analogy. We'll cut that out. But it's an attachment to the big thing.
Yes, it is trying to build it on top of that security.
But it's
model.
also its own thing.
Yes, and that's really just the problem with sidechains is that because the main chain, in the case of both Bitcoin and Ethereum, are not built to support these sidechains. At least they haven't been built initially for them in mind. Sidechains came up after. there just is a limitation to how much security you can truly borrow, because ultimately it comes down to what does the parent blockchain say, and the parent blockchain can't speak for what happens on that sidechain because they're separate, and they sidechain processes transactions separate, and the validators running that sidechain are the ones typically telling the main blockchain what's happening. So you have to trust those validators to be honest, and that's ultimately the risk you run. So we actually use Polygon not for. We actually use both Ethereum mainnet and Polygon, but we use Polygon for managing, and this is actually a project that OpenZeppelin incubated, so it's not directly OpenZeppelin, but there's a project called Forta that's trying to manage some security monitoring software, and you can register bots on Polygon. And there's a lot of activity going on Polygon, so it's very cheap. But the actual funds that you would use to stake on those bots is actually on mainnet Ethereum. So we try to focus on, okay, operational stuff happens on Polygon, the actual large amounts of funds that are being locked up happens on Ethereum mainnet, and we keep those separate because the custodial risk is lower by using Ethereum, and we don't have to move money around as much, and we can do more operational stuff here that is cheap. So it comes down to trade-offs in use case, but sidechains in at least Ethereum are not viewed as a final solution, but actually, in the case of Polygon, they actually are going to be focusing on what we'll talk about next, which are rollups, ways to actually scale with decentralization and security, essentially a part of the system. You're trying to not give that up. So even Polygon admits, hey, we built sidechains today because it was the fastest way to give people scale now. But long term, we're actually going to move this platform towards layer 2 solutions that are more secure and more decentralized. So it's kind of at least in the Ethereum world, it's still a known thing. I think there's still some sidechain projects like Liquid and Bitcoin that are trying to make sidechains work. With Ethereum, they've kind of given up on sidechains. They're moving to something else, but we'll see how the future holds. Right now, sidechains, I think, have a lot left to be desired. All right, so now we get into the fun stuff, rollups.
Now we're in the fun stuff?
Oh, yeah.
Is this the stuff that's going to melt my brain?
Possibly. We'll see how it goes.
We'll see.
The ZK stuff does, but we're not going to, that melts my brain, so I'm gonna keep it light. So this is something that really applies a lot to Ethereum. There are rollup initiatives on other blockchains as well, but Ethereum is really where you see the most rollup activity. Because Ethereum, again, was like, we want to scale. It's not clear. There are some scaling solutions they want to do on the main blockchain, that is improve the Ethereum protocol, but there's limitations to that, and it also takes a while to change the protocol safely. So Ethereum is really focusing on rollups, and the reason that they like rollups is that it can offer a lot of the same benefits that sidechains claim to in terms of just processing all these smart contract transactions off-chain, but it can do so with the ability to borrow the security and decentralization of the main protocol, very similar to the way that payment channels and Lightning do for Bitcoin, but for smart contracts, and with what is known as data availability, which is to say you don't have to trust the Lightning node to store all that data. In the case of rollups, that data is still stored on chain.
Can you define rollup real quick?
Yes. So really, a rollup is just a way to process smart contract transactions off chain. And they are essentially then, these transactions that are run off chain are then rolled up into the main blockchain. And that's basically like batching. It's like, you have a big movie, for example. And if you tried to put that movie on 200 different devices, it would be really expensive. So let's say you just compress it down into the lowest file count you can using some sort of compression software, and then you put it on the
Is it
thing.
similar to, I forgot which lesson it was in, but it was like when you're stacking things for the hash. Maybe I'm way off.
It's similar. It's basically like, yes, you can take these transactions and compress them down.
What was that called? Just, you know what I'm talking about?
I'm not actually sure, but
Yeah.
I think it was probably something to do with like, okay, well, you can hash data and then put it on chain, and that's like a hash anchor. It's similar to that, except the data is there. You can still put the transactions on Ethereum, but you don't process them on, because at least for Ethereum, when you're running a transaction, there is execution and storage. Those are two separate things you pay gas fees.
So a rollup is basically, like you said, rolling up all this, like, it's accumulating a bunch of data, and instead of sending it piecemeal, it's sending it at once.
Yes.
Okay.
Yeah, so we can save a lot on storage costs there, and then we don't even have to execute it on chain. The idea being like, okay, we're running so it's kind of like a sidechain in the sense that you're running these smart contracts on a separate network, but you don't have to trust that network's validators. The people running that rollup, which are typically like validator nodes or sequencers, they will take all these transactions, they'll execute them, and then they'll post the batch transactions rolled up onto the main chain. And the purpose of that is to give people the ability to verify that the execution that was done off-chain was done correctly. In the case of optimistic rollups, which are kind of the most common rollups we're seeing today, they do this by just batching those transactions and then allowing anyone to do a fraud proof, which again, similar to a payment channel, hey, someone points to that transaction that they rolled up and says, you executed that wrong. What they can do is they can submit a fraud proof and then have it be rerun on the main chain to see, okay, does it come to the same result? If yes, then, well, it was done fine and there's no problem here. And if no, then we will make sure that we revert that and we make sure the right execution will occur. And you can kind of see this chart where it's like, okay, we have a fraud proof. Either it's valid and no computation is needed, we don't run anything on chain, which is 99% of cases. We don't have to run anything. It's therefore cheaper. And then in the few cases where someone might try to cheat, we will be able to run it on chain, identify as invalid, and then we'll also be able to penalize whoever submitted that false transaction, potentially with slashing some sort of stake that they put up for good behavior, and a lot of other things. And so you can kind of think of it like a lower court and a higher court system. So you've got the Supreme Court and you've got these lower courts. And we don't want it to, for example, process traffic tickets at the Supreme Court. The Supreme Court has better things to do. They'll let the lower courts with some judge who's probably not the most illustrious judge. He's doing his job. He's doing.
But there's a lot
court.
more of them.
Yeah, there's a lot more of them. You can pull from a bigger pool. It's a lot less resource intensive. They're just sitting there in traffic court going, yep, you pay that ticket, you don't pay that ticket, just banging the gavel all day long. That's kind of like your roll-up, cheap, easy. But let's say at some point that judge decides to interpret the law in the wrong way. There's like, you know what, I am the law. You're gonna have to pay $1 million for this traffic ticket because I just hate people that cut me off.
I gotta add one bit of humor. Did you ever see Judge Dredd?
Yes.
I am the law.
Yeah. So you don't want any Judge Dredds in the traffic court, basically.
Sorry.
Yeah. Well, exactly. I was like, okay, well, what happens in a normal court system? Well,
You appeal.
You appeal. So you appeal up to the Supreme Court, and the Supreme Court's like, yeah, no, the law was not written, and it might not even be the Supreme Court. It might just be another court. But eventually, if for some reason you keep appealing, it eventually will hit the Supreme Court, and they will say, yeah, no, the law says you can only be charged up to $250 for that kind of a offense, and they reverse the decision. It's very similar to the way that optimistic rollups work. You are going to do a lot of the transactions off-chain for the purpose of just scale, but we have this cryptographic guarantee, or really just an ability for someone to dispute a transaction that might have been done incorrectly on-chain, where we do have this maximum security and decentralization.
Now, is that all in the same rollup, or is there a second? Is it because you use the analogy of lower courts and higher courts? Is the rollup all the courts, or is the rollup the lower courts, and then there's another rollup on top of that? Or is that rolled up into the rollup?
Oh, okay. So this is getting into kind of like what we could do in the future. For now, for today, it's just the Supreme Court, higher court, which is Ethereum, and then there's the lower court, which is the rollup. So that's
what I was missing.
There's just
Ethereum
two layers.
Ethereum is the higher court.
Exactly.
Got it.
Yeah. There is a future of, well, maybe you can make a rollup on a rollup. That's been discussed. I don't think we're there yet because rollups are still very new.
Well, I just invented that by saying. So somebody pay me.
There you go. So yeah, so Optimism and Arbitrum, they have several $1 billion running on these rollups today. They've just really been released in the last year or two. We actually audit a lot of them at Open Zeppelin. We've worked with Optimism specifically. And so, the security is there. There's still a little bit of work to be done on making them more reliable, adding in some ability to ensure that the decentralization is there. Some of them, there are still some centralized aspects to rollups on Ethereum today because of the fact they're kind of in beta. But the technology and the designs are built specifically to give you that trilemma of it's scalable, but you also get the security and decentralization because you can, basically appeal back up to Ethereum where you do have that guarantee. Now, the other thing that is really cool, but also really hard to grasp, or at least the technology that makes it work is hard to grasp, are ZK rollups, that is zero knowledge proof rollups. The reason it's difficult to grasp is because there's just some crazy black magic math. It's like a black box that very few people in the world can truly understand well. There are, a good amount of them that are,
Challenge accepted. Let's go.
Oh yeah, you can get a whole PhD just on how the heck do zero knowledge proofs work. That's the kind of level of math we're talking about. We're talking about like how does cryptography at its essence work, sort of math. But we have seen examples of them working well. And so the idea is, well, we can use zero knowledge proof technology, and the zero knowledge proof is really just I have a formula that will render a result, and I have some input. So for example, it could, like an example we've used in the past is I am wanting to go into a bar and I want to purchase a beer, and the bar needs to know that I am over 21 based on some legal ID. What we do today is we give them our whole ID, which includes our name, our address, our driver's license number. Yeah, they have all this personal information. If they wanted to be nefarious, they could take pictures of every ID they card and have like a treasure trove of personal information. Let's say I don't want to do that. I just want to verify I'm over 21. What a zero knowledge proof can do is allow me to input my driver's license and say, here's my information that you can verify. I'm verifiably over 21 based on my birth date. And it will give an output, which is this person is indeed over 21. And it might reference my public key, for example, that no one knows anything about except the fact that I have a proof attached to it. And then I can present that proof to the bartender, and they would have something on their app that could verify that proof without the input. So the idea of a zero knowledge proof is I have zero knowledge about what you gave me to prove this is correct, but because of the weird black magic math that makes this work, I can verify that. And that is actually really, really powerful. Like there are so many use cases.
I don't understand what's so, and I'm not trying to be comedic here, I don't understand what's so complicated.
Well, it's
like the math itself, I can understand why
Yes.
the cryptology and the math would be super complicated.
Yes.
But in concept, it seems pretty easy.
In concept, it is easy, and that's
okay.
That's actually the promise of ZK rollups is if we can get it to the point where the technology is trustworthy. And that's again the thing is we want technology that is open source and people can understand. And so there's been hesitancy around ZK rollups and just zero knowledge proofs in general. People are like, this would be great, but we just need to make sure it works and it works well because whoever builds it needs to make sure it does that job and it doesn't mess up.
And maybe I'm missing something, but it sounds like it's just basic cryptology. Where like the Enigma machine where all you get's the output and you have to figure out what the input is from after you break the code.
Yeah, it's more advanced than that cryptography. It's really like a next level is what I would describe it as. And that's why it took decades and years to build the cryptography we use today in a reliable format. So zero knowledge proofs are kind of an additional layer of complexity. That's really it. And so you could talk to a mathematician that would give you way more definite, detailed academic answers for why it's difficult. But it is possible, and we've already seen them built in limited fashion. And so the real question is just getting to the point where we trust that technology. Because, for example, people trust Bitcoin because compared to Ethereum, it's simple, And some people don't like Ethereum because it's more complex. Well, zero knowledge proofs are just another layer of complexity on top. So the real thing with zero knowledge rollups is we want to get to the point where we can trust them. But again, the advantage is once we feel like we can trust it, and we're actually, it opens up and we're looking at potentially auditing some zero knowledge rollups, which is like, oh, we're going to have to really brush up on our math. We'll see. But once you're at that point where you can trust it, then it scales even better because what I was telling you before about optimistic rollups, where they need to take all these transactions and compress them down, they still need to post them on chain. So there's still some data storage happening on chain that you might say is, it's still going to cost potentially something per transaction. So maybe a rollup that's optimistic goes from, $5 per transaction on Ethereum to like 10 cents per transaction, which is an improvement, but we want to go further. The best thing about a zero knowledge rollup is that proof that you would then submit on chain as a result of that zero knowledge proof. So essentially all these transactions are running off chain, put it through the zero knowledge proof system, come up with a proof, submit that proof on Ethereum, where Ethereum can validate, yes, the proof is correct. That's essentially how a zero knowledge rollup works. The best part is that proof doesn't change in size if we have more transactions. So what's really wild about zero knowledge rollups is that actually, if you have more transactions on the zero knowledge rollup, the cost per transaction can actually go down because the proof is still going to cost the same amount and be the same size. So some examples of this are ZK Sync and StarkNet. We actually work closely with the Starkware team behind StarkNet to help them build a library on their new zero-knowledge rollup framework called Cairo. So it's open up, and we're working a lot with them. We've been really impressed with the technology, but it's still like in the early stages, I would say. StarkNet just launched with their beta. They only have like I think $600,000 worth of value trading on it, just as an initial starting point. But there's a lot of promise here. And then ZK Sync is actually trying to build a rollup that is going to be fully supporting smart contracts for Ethereum, which is more difficult to do because you have to make Solidity contracts work with this crazy math proof. But if you can get that, then you have a great platform because you can take smart contracts that work on Ethereum today and have them run on this zero-knowledge rollup with that great scale and security. And StarkNet actually has their own language they built to make it easier. But so we'll see which of those work out best in the long term. But yeah, it's really exciting to see this kind of development. And so, I mean, it would be really interesting. It's been talked about some, but it's very controversial. Is like maybe someday Bitcoin could support zero-knowledge proofs on the Bitcoin protocol, and then they could support these like smart contract rollups off-chain. But again, that requires trusting the zero-knowledge proof system, and I think we'll see. There's going to need to be a lot more time for it to develop and mature before I think we're going to see that level of adoption. But we're in the early stages here. Again, this still feels like an early industry, and these are like some of the cutting-edge ways that we're seeing, Ethereum, but also other blockchains try to scale today. So, I got a quick comparison chart that kind of talks about like what are some properties of all of these examples that we've gone over. So
before you do that, because you said layer 2 earlier.
Yes.
And I see it on the slide. What does layer 2 even mean?
So it's kind of a catch-all term, and it can mean different things to different people in the industry. Some people would actually say that a sidechain is not a layer 2 because it doesn't borrow security decentralization, but generally speaking, a layer 2 just means a way to run smart contracts or run blockchain transactions on a layer above the mainnet that gives it more scale. So you can think of a pyramid, like Bitcoin and Ethereum is like at the top of the pyramid. They're the core piece of security, but there's not a lot of capacity there for a lot of transactions. The layer 2 is what gives it that capacity to scale.
Okay.
So generally speaking, that's a layer 2. Some people in Ethereum only consider rollups to be layer 2s because they're the only ones giving full security. It's kind of still a catch-all. Depends on who you talk to. But yeah, when we look at this, payment channels, what we see here is a lot of great features, but it has payment support. It doesn't have smart contract support, at least not in to the same degree that it provides the same security. It does have that mainnet security because you have that ability to exit from that channel to the Bitcoin chain and get your money back. But the only caveat is you need data availability in your Lightning node. It won't provide that on its own. So you just need to make sure you protect your data when you're running a Lightning node or trust someone else running that Lightning node to do it properly. And then, there's also potential for privacy protection. There's a lot of solutions people have been working on for Lightning to make it more private because you have all these transactions processing off-chain. You can kind of abstract that away from the mainnet, and not everyone necessarily needs to see what happens in that channel. So a lot of it depends on how you set up the channel, and there's a lot of privacy solutions people are working on with Lightning. So we'll have to see what plays out there. Again, someone else would probably be able to speak to that much more confidently, but I do know that there are some possibilities people are exploring. And so sidechains, we've talked about that. They can support payments, they can support smart contracts, but they don't have that mainnet security that we really want, and that's really the big downside to sidechains. They also don't provide data availability in the sense that the data on that sidechain typically isn't being placed on the mainnet, otherwise it would struggle to scale. They might post hashes of data or other things that kind of try to link it to the main blockchain, but that doesn't provide full security, at least not the sort of security we'd expect of like a mainnet transaction. And so Liquid and Polygon are two examples. We have sidechains on Bitcoin, on Ethereum. We probably see sidechains on other chains as well as they need to scale. But generally speaking, they're kind of a quick and dirty way to scale quickly with smart contracts, but they typically just don't have the security that we really want for a long-term solution. And then finally, we have rollups, both Oprimistic and ZK. They're all kind of similar across the board. They have payment support, smart contracts, mainnet security, and data availability. That is, you don't have to run your own node to ensure that the data is available because the proof is going to be either in the compressed Oprimistic rollup transactions, or the proof is literally in the pudding, as in the ZK rollup proof, which is submitted on chain and can be used on its own to prove that the transactions were done securely without actually having the transactions, which is still absolutely mind-blowing. So that's kind of all this in a nutshell. You can kind of tell I'm definitely biased towards rollups. So I'm going to tell you now, for those of you watching, I work on Ethereum a lot. We see rollups a lot. That's kind of where I'm angling. So again, someone who does Lightning or payments might say, oh, well, there's a different way to do that. And I haven't seen any that I think are getting the same properties, but maybe I've just missed them. But generally speaking, rollups are kind of, I think, where we're seeing a lot of the layer 2 solutions be most successful. And so optimistic rollups for kind of today, because they are simpler to implement, because of that, you can if you understand that court system analogy I gave you, you understand the core of how it works. Whereas with the ZK rollups, you understand, how it would work, but understanding what happens under the hood is where like a lot of people would struggle. Even I would struggle. So we're going to wait and see it play out to make sure that it's truly something that's secure. And I will say for privacy, sidechains could offer privacy depending on how they're set up. Most don't, but they could. Optimistic rollups typically no. And then zero-knowledge rollups probably could because of that zero-knowledge property. You could have a zero-knowledge proof where you don't need to know the input, therefore you could keep some personal data private. Most ZK rollups today are not building for privacy first because scale is really where they're focusing their head, and that's difficult enough. But long-term, there's been discussions about how they could also enable a lot of privacy properties as well. So we will see how that plays out. So now we're going to kind of change gears. We've talked kind of about scaling solutions that are very specific to Bitcoin and Ethereum. And these still remain the most popular public blockchains. Bitcoin is the most popular for money and payments, and then Ethereum has become very popular for like smart contracts and DeFi and NFTs and stuff like that. That's really where we've seen the majority of activity, and you can see that reflected in the market caps for both. But there are many now attempts at trying to basically say, well, we'll take all what we've learned seeing Bitcoin and Ethereum do what they've done and try to make it better. And that's where you see altcoins that are trying to be their own layer 1 blockchain protocol, which would be how you differentiate it from layer 2. They're like trying to be their own blockchain independent of Bitcoin or Ethereum or anything else. They want to be the next big bad blockchain on the block.
Yeah, and prior to today, I thought that's how all of them were. Like, because you hear things like thrown out, like there's 20,000 altcoins out there or something like that.
Yeah.
And I thought all of them were trying to be that layer 1 main block chain type of thing. So like that side chain and all the, just realizing that, oh, I really don't know anything about this is I mean, I already knew that, but so when people say there's 20,000 cryptos or whatever, like how many of those are side chains and how many of those are the main layer 1s?
It's a hard.
You see what I'm getting at?
Yeah, it's a good question. It's hard to tell. Some are so. I guess to classify them broadly, yeah, some are layer 1 blockchains that are either trying to be their own payment protocol, like Litecoin or Dogecoin. Like those are all just independent on their own, independent blockchains. You have side chains like Polygon or Stacks that are essentially, they have their own token, but they're depending either on a parent blockchain like Ethereum or Bitcoin. So they are still their own cryptocurrency, still used for fee trading, but they're a network that is trying to be directly tied to another. And then you have kind of these tokens, which is to say it's probably treated like a crypto in the way you can trade it and interact with it, but it's probably running on a blockchain like Ethereum, ERC20 tokens. So those are, I think, the 3 ways you can classify it. Either it's a layer 1 blockchain on its own, it's a layer 2 blockchain that's trying to be tied to another layer 1 blockchain, or it's a token that is running on one or all of those, but it doesn't have like its own network of nodes. 2 examples of layer 1 blockchains we can talk about. And these, I will say, these are kind of examples that are focused more on Ethereum competitors. Bitcoin has had a lot of payment competitors, like even as early as 2012 of like, well, I can do payments but better, like Litecoin. Like, oh, we're going to reduce the block times and we'll be faster, and there's going to be 4 times as many in the supply, so silver to Bitcoin's gold. That was their kind of take. And you had Zcash Monero that were trying to be more privacy focused. You have a lot of others. So Bitcoin went through its own round of people trying to, be a better money, essentially. Ethereum is really trying to do more smart contracts, which is why I would classify them separately. And because they're doing their own smart contracts, or just really focusing on that use case, that's their, money is also part of what you can use Ethereum for, but it's really focused on smart contracts. And then because Ethereum's been successful, a lot of people are trying to do what Ethereum is doing better. So I focus more on the Ethereum competitors here than I do the kind of Bitcoin competitors, but they're all layer 1 blockchains in the sense that they're just trying to do something on their own better than what was done before.
Well, what I've learned in my time at the TBC is Bitcoin doesn't have competitors.
Yep. Well, Bitcoin does Bitcoin. That's the thing. Things will call themselves competitors to Bitcoin, and Bitcoin will continue on its own. That's why it's the original layer 1.
Yeah.
And again, even Ethereum and many others have based a lot of their code on what Bitcoin did.
Right.
In fact, we'll talk about a lot of the similarities or differences between some of these, because I say DLT frameworks here because there are some that are trying to literally rewrite the whole book and not even use a blockchain and use something different to achieve the same
And what
result.
does DLT stand for?
Distributed ledger technology.
Got it.
So it's kind of a catch-all term. It's like, every blockchain is a DLT, but not every DLT is a blockchain, sort of thing. So 2 examples. One is Solana, which is trying to improve scaling with a highly performant protocol implemented in Rust and run on really expensive server equipment. And by that I mean, usually a node for a Bitcoin could run on like a Raspberry Pi or something really small. And then a node for Ethereum is a little bit bigger, but it could still be run on like a typical computer or laptop. Solana nodes are like 120 gigs, massive uptime, massive storage. Like they're running in a data center. Like you don't run that stuff at home unless you're, really committed. So we're talking about a more centralized network and sacrificing some of that decentralization for scale. And I will also say that in the case of Solana right now, July of 2022, it has had occasional downtime. It has like cases where it's running too many transactions. Like it tries to process thousands of transactions per second. It's hit like a max of 100,000, but then it starts to actually have some instability, and it actually has gone down as a result of that. So there are some downsides to being too fast. And Solana, maybe they eventually will resolve those. They're still technically in beta. But so I would say that, they've made an explicit, They've made an explicit trade-off with decentralization. There's still like roughly 1,000 validators running on the network, so it's not that it isn't completely centralized, but it's definitely less so than Bitcoin or Ethereum. There's also a question of how the crypto was issued to people, so there's kind of a disagreement about how much it went to VCs and stuff, but I won't get into too much detail because I'm not here to bash any specific crypto. I'll just say there are trade-offs that they had to make. And then Cardano, which is another one, they are doing some sort of a novel UTXO-style smart contract framework. I won't go into detail. The point being they're trying to do something really scientific and academic approach. So that is to say they do a lot of like peer-reviewed papers. They implement a lot of their protocol in Haskell, which is a very functional math-based programming language that isn't very popular outside of specific like academic circles or mathematicians, but it's easier to like verify and prove that it's secure and stuff like that. It has been reported as difficult to build on, but it was started by a Ethereum co-founder named Charles Hoskinson, who was working with the original Ethereum team, including Vitalik. But he was like, I don't really like the approach here. I wish we were more, taking a more academic approach or more scientific approach. And so he started Cardano to kind of go down that path. So I would say they're trying to also hit the trilemma of scale, security, and decentralization, but they've kind of the biggest trade-off that they've now suffered is, I think, usability and developer friendliness and stuff like that. So the theme that I'm going with these slides is trade-offs. There are trade-offs usually to try to be faster than Bitcoin or Ethereum.
Yeah, because like these two, Solana and Cardano, like I've heard of them. And my mentality is if I've heard of something, it's probably, I don't want to, if I've heard it, it's mainstream. Super mainstream.
At least within the crypto sphere, yes.
That's what I mean. Yeah, because there's like, I was talking to, at the last Austin meetup, somebody was telling me about a coin, like an altcoin, Elon. and I'm like, huh? What? And, but it's like, unless you're in the know, you're never going to learn about that. But like the Solana and Cardano, like, for me, those are mainstream.
Yeah. Well, yeah, they're mainstream crypto. I think they're both in the top 10 market cap right now.
Yeah.
And I'll say for Solana, like I do like some of the things that because I kind of bash them a bit. I'm going to say they're doing some really cool things. They are trying to build they are actually much more focused on developer ecosystem. They're building, they've got a lot of library support that, they're also centralized in the sense that the Solana Foundation, the entity behind Solana, takes a much more direct approach in building developer tooling. Because like Bitcoin and Ethereum, they're kind of like, let's let people build their own tools so that it's not centralized under one entity. Solana's like, screw that, we're just going to build it so that it's there. So they build out some really good like standard libraries. They build out a lot of good CLI tools. They've got really good wallets and grant programs that are really user friendly. So I've used Solana a little bit in terms of their apps, and I'm like, it works pretty well when it's running. It works pretty well. So that is just so. Again, I'm not trying to bash anything here. I'm trying to just convey there are trade-offs to each of these approaches, and the question of whether you like Solana more than Ethereum is really based on what you value most. So let's go into the next thing, which are private blockchains. This is something that I think in the traditional blockchain, like I would say in the Bitcoin and Ethereum worlds, there's a lot of skepticism about private blockchains, and I would say deservedly so, because it was like this is really the source of the blockchain not Bitcoin crowd, is private blockchains. The IBM that created Hyperledger Fabric as a private blockchain was going to people saying, well, you don't want to deal with this crypto stuff, but you can get all the cool blockchain stuff with this private blockchain. And it wasn't coming, I would say there are some, what do you call it? I understand the approach. I understand why you're like, hey, if you're an enterprise, you don't want to have to deal with this weird, cryptocurrency. You just want something that runs kind of like a database service that you normally are used to dealing with. So we'll give you this blockchain that's going to be more scalable, it's faster, it's more private. So it's understandable why someone would want a private blockchain. That being said, I think there are some downsides to it that I'm going to talk about from experience. Hyperledger Fabric is one. There's another one called Besu that's based on Ethereum. So I've worked with both of these protocols before. And so I can speak from experience when I work with these disadvantages, because I've worked with this at the corporate level. I worked with Fabric at some consulting at Verizon. I worked with Besu, Ethereum at Toyota. The really biggest advantage or disadvantage is getting effective network decentralization and governance is really difficult, because the original idea is, well, it's faster, we only need 12 nodes, we'll set it up between all of the business entities that'll be part of this. So like IBM's food trust with Walmart, Walmart and all of its supply chain partners will all run nodes, and this will be a distributed network that they can share data and track food throughout the supply chain and trace food outbreaks to do more accurate and effective recalls. That was like the vision. And it's still running today, and they've had some limited success, but the real problem they've had with getting wider adoption is, well, Walmart's involved, so people kind of read between the lines and say, well, Walmart's really the one running things here. Like, yeah, I can stand up a node on Hyperledger, and doing that can be a little technically challenging, it can be very costly. In the end, it's really Walmart calling the shots, at least from what a lot of people say. So really getting these business stakeholders and competitors to sit down and agree on like running this protocol effectively and trusting each other is difficult. You get back to the trust problem, the very reason we have blockchains in the first place.
Yeah, because in that scenario with Walmart, it's from a consumer standpoint, depending on what the blockchain is meant to do, if Walmart owns it, I'm going to immediately not assume, but rightfully know that they're going to be doing actions that better Walmart. And from whether that be like getting consumer data or whatever it may be, they're going to be doing things that better the stock price of Walmart, period. And I'm not saying it's nefarious.
It's just incentives.
Yeah.
Yes. Yeah, and I'm not saying this to say I think Walmart was doing, I don't know enough about the inners of IBM Food Trust to know if Walmart was like truly trying to be dominating it, or they were genuinely, intentionally saying we want people to join this and be equal members. What I've heard is just people were, regardless of what the truth is, they just weren't buying it. They were like, we don't like the impression of this. And I've seen other private blockchains that also run into the same problems of just like managing this is hard. Just deciding when are we going to update? How are you going to update? Who's going to pay for this? Who's going to pay for the development? Like there's just all these big questions that come up that are very complicated to solve at one company, much less 12 trying to all come into an agreement. So I think that's like the core problem, is just getting that decentralization is difficult. And then in terms of just running nodes, that can be difficult. Like I've had trouble, I've seen production Hyperledger Fabric instances really struggle to run that self-hosted, as in running their own node. A lot of them end up going to Amazon or IBM and using their Hyperledger Fabric managed service to run all the nodes. Well, then it's like, well, now it's just Amazon running your whole system. Why even bother running a blockchain at that point? Just have them manage the database and tell them that, oh, we'll trust Walmart. or I'm sorry, we'll trust Amazon or IBM to be honest. And that's a lot of dependency. Some businesses are possibly fine with that, but I think in general it's been a big barrier to greater adoption. And just the fact that these can just be very difficult frameworks to support and maintain. It's new technology. Like I learned enough about Fabric to tell you, like it has some really cool properties that they built in to try to make it better, but it also made it more complex and difficult. And even private Ethereum nodes, which I think are, from my experience, just easier to set up and maintain, still have some disadvantages. And even then, it doesn't scale all the way. You were talking about you can run thousands of transactions per second, but at some point it actually starts to still hit scalability problems if you're comparing it to like a normal database that people might otherwise be using. So in general, it's just difficult. And then the final kind of biggest problem is there's no interoperability with other blockchains. Like you build this IBM Food Trust, great. Well, I'd like to do a payment in Bitcoin, please. Well, there's no direct interoperability for that. You are going to have to create a bridge where you're bridging over the Bitcoin, or you're creating someone that you have to trust to custody that Bitcoin. Like Hyperledger Fabric has no way to talk to the Bitcoin protocol. And the same would be true for, let's say, a Hyperledger Fabric instance. Let's say that the IBM Food Trust is doing great with food, but there's another, agricultural blockchain that someone set up with Fabric. Even if they're still running the same versions of Fabric, they're separate networks, and there's actually no good way to get them to interop with each other. There's been some solutions that have been proposed and some ideas, but it's really not clear how you would do that while still maintaining the security of the thing in the first place. So that's really the core problems that we've seen with private blockchains. And so we've seen some implementations that seem to have had limited success, but I don't think this is where the biggest innovation is happening. I think we're likely going to continue to see that happen in the public blockchain space, because that's where you get that trust automatically. You don't have to try to build it from scratch. So finally, we're going to talk about another kind of class of alternative frameworks, which is not even technically a blockchain, although sometimes they get called blockchains anyway because it's just kind of a catch-all term, which are DAG DLTs. And when I say DAG, I mean a directed acyclical graph, which is just the computer science term for it's a graph going one way. So it's kind of like it's a set of points, it's going in one direction, and when we say a graph, in this case, we're actually talking about a set of messages that are being shared between participants. So the idea of a DAG is like we can gossip about transactions between nodes without having to confirm them in a block each time. Because when you think about the way a blockchain works, is when you have to wait either 10 minutes in the case of Bitcoin or 15 seconds in the case of Ethereum, you're kind of putting a time on, well, okay, I can submit my transaction and then I have to sit back and wait for that block to get confirmed. And it happens in batches. We're kind of like, we're batching up the transactions and having a block producer mine that block and submit it to the chain. And there's a lot of great security properties around it. The reason we do that is sound, but it does mean that we have to wait. Whereas with a DAG, the idea is, well, we can process each transaction individually. We can let it, get gossip between nodes. And the idea is that when it reaches a certain majority of nodes, let's say 2/3 of the nodes, we're going to consider it automatically confirmed. So, basically, if you're a node and you receive a transaction, you're going to look at the transaction, you're going to verify it, validate the signatures are correct, the smart contract operates correctly, and you're going to forward that to the other node. You're probably going to, or send it to several nodes. So by virtue of just sending it onwards, of gossiping, you've kind of signaled your support for it. So this isn't normally how it works in the Ethereum, or in Ethereum, normally the nodes do gossip, or both Ethereum and Bitcoin. Nodes will gossip, the transactions will be formed, but only does one block producer actually take those transactions and then validate them and put them in a block, and then everyone else just double checks that it's correct. Whereas with this, all the nodes are kind of participating. So this has advantages because it can be a lot faster. It can be, you can have transactions that process asynchronously. And a good example of this is a local company called Hedera. They created a form of this called a hash graph, which was kind of their own custom take on a DAG approach. This is kind of the diagram I'm showing here. And yeah, same thing. They have this enterprise-focused public DLT governed as a public network by a council of enterprise members. So there's I think right now about 26 to 27 council members that are running nodes. And they're planning to get up to 39 at some point. And so they've got this hash graph. It's very fast. They can claim to get up to 10,000 transactions per second. I think on average they process usually 500 to 1,000 on average with their current system. So a lot of advantages with that. We're actually working with Hedera at OpenZeppelin because Hedera is actually trying to support smart contracts with Ethereum now. So we're working with them to help provide our security tooling. And so, they're actually, I think up until recently, members of the Toxis Blockchain Council. So, and hometown team based here in Dallas. We could almost walk to their offices, I think, from here. And they're taking a very enterprise-focused approach. They're like, we're only going to have enterprise members that are running nodes. We're going to, have, I think, a lot more centralization in terms of who controls upgrades and changes through this governance structure. But it's something that's more friendly to enterprises. It's something they can trust. They can see these brands like Google and IBM that are running nodes, and they're like, oh, I'll trust them to run nodes. I don't know what this weird Ethereum or Bitcoin thing is, but they seem to be running something that I can understand. So that's kind of their approach. There are other DAG-based platforms like Phantom and Avalanche that are actually they're standalone blockchain kind of approaches, but they're explicitly trying to support like Ethereum smart contracts and then other smart contracts that are a lot faster. So they're similar to Hedera, but they are usually, I think, a little bit more like Ethereum in the sense that they're just supporting the smart contracts and then other approaches as well. So they're kind of like generic smart contract, but with a faster DAG-based approach. And then Hedera is, I would say, the more, using their version, which is a hash graph, and being more enterprise-focused. So in general, I lump them all under DAG DLTs because they're using this form of a data structure. And the disadvantages that I'm listing here are similar as well, which is typically these nodes are also high-performing. That is to say, running Hedera nodes are not, they're kind of similar to Solana nodes in the sense that they're usually pretty high-performing, kind of data center-based nodes. And you also, usually they're semi-permissioned. In the case of Hedera, only those council members run nodes. I think Phantom and Avalanche have a similar structure, although I'd have to check, where you typically don't have a lot of validators, and the nodes themselves have to be beefy because they have to check every transaction that they're gossiping. So they have to be able to keep up. So this is kind of a caveat to decentralization. The other significant issue is if nodes go offline, you have the potential for network disruption. And that's different than, for example, Bitcoin or Ethereum. Because in Bitcoin and Ethereum, we could have half the miners go offline and half the full nodes go offline, and the network would still continue running. Because it would just, whoever's still online would still mine the next block, they would submit it, all the other full nodes would check it, and then we'd move forward. The reason it's a problem with DAG DLTs is because of the fact that when I said, oh, we'll automatically assume that this transaction is confirmed when 2/3 of the nodes run it, right? What's 2/3 of a total node count that could change? So with Bitcoin and Ethereum, there's no, oh, we're going to calculate it based on 2/3 of the nodes. The node count can change, and proof of work doesn't have to care about the node count because it's a totally separate thing. With DAG DLTs, they need to know that node count. Otherwise, how do you tell when you've reached consensus? Because if I knock out half the nodes, but you're still going off the old node count number, then we might be able to reach consensus because we don't have enough to reach the old number of nodes at 2/3. If I knock out half the nodes, then we'll never reach that. We have to readjust. And how do you readjust? Well, there could be ways that you build into that, but it will likely cause disruptions. So I would say decentralization and security in that particular sense are more difficult with DAG DLTs. But you do get properties of greater scale. And if you can set up nodes that are well protected and set up well, like Hedera is trying to focus on them being fairly, what would you say? They're all like geographically distributed. They're all run by very technical enterprise members. So again, I think that's not a serious a concern if you're an enterprise member and you're okay with the fact that they're Air Force professors, the founders of Hedera. They know what they're doing with security. So when I say security, I don't mean it's insecure. I mean it is not secure in the same way Bitcoin and Ethereum are secure in terms of nodes going online or offline. So that's, again, trade-offs. And then finally, what we're talking about here are sharded blockchains. So these are, for example, Cosmos and Polkadot, and actually the future roadmap for Ethereum.
I have not heard of these two.
This
seems like it's more in the because like the other ones, yeah. Even though I don't know what those are, I at least know I've heard them before. But Polkadot,
yeah.
Like, who would put money in that?
Actually, I bought a little bit. That's pretty good. But I'm a nerd, so, it's He's actually the guy who built that was actually another co-founder of Ethereum that went off and was like, I'm going to do it different.
Well, why would you name it Polkadot?
You'll have to ask him that. These are all built by developers for developers. The names are supposed to be fun and silly.
Got it.
Even though, oh yeah, I'm running on Polkadot. Trust me, it's secure. Yeah, but I like some of these approaches because what they're basically doing is they're saying, you know what, running it all on one node, or basically running this all in the same environment, is going to eventually hit capacity limits. That requires us to either increase the size of the nodes, but the approach that sharded blockchains take is, well, what happens if we split up the work amongst the nodes? That is to say, well, instead of 1,000 nodes, let's say it's a total
doing the same thing.
Yeah, we say, okay, you group of 50 are going to do this slice, you group of 50 are going to do this slice, and so you start to shard out the blockchain into smaller instances. And so that's the idea of a sharded blockchain approach. So Cosmos and Polkadot are both kind of like proposing this like hub and spoke model where there is a relay chain. There is a chain that is going to act as kind of the main coordinator. But a lot of the activity is going to happen on these sharded blockchains. You could almost think of it as a side chain, but it is explicitly supported. It's tied into the protocol. So unlike a side chain where you're not getting the security and decentralization guarantees, you are, however, getting the security and decentralization with in the case of Polkadot, they call it a parachain or a sub-chain or whatever you want to call it. So that's the idea. And then you actually have Ethereum, which was originally thinking of the same thing. They, literally as of a year or two ago, Ethereum was looking at this roadmap of sharding that people have talked a lot about, and thinking, let's split up all the work among different shards. And that is to say, not just, the idea being they would almost be like their own sub-blockchain. But there were some concerns around the complexity that would introduce. And there's also still this question of, well, you still need to maybe, if you have a sharded blockchain here with a smart contract that wants to talk to a smart contract on this other sharded blockchain, you have to now pass messages back and forth or maybe use the relay chain. So there's some limitations that get introduced there. And Ethereum actually realized as rollups start to take on this role as the place where all the transactions are being processed, you might not actually need to shard execution of transactions. You could actually say, you know what, rollups are doing a good job of that already. So why don't we do a kind of a limited form of sharding that has been called dank sharding. It's named after a guy who has the word dank in his name. I can't remember his full name, but it's a cool name, clearly. So dank sharding is the idea, well, let's just shard data instead of sharding the whole thing. Mm-hmm. So we'll still process all the transactions in one chain, in the beacon chain, or in the the one execution chain. But we'll split up the data storage for all the data that we're storing for these rollups among a subset of nodes, and that is actually simpler to implement than sharding the whole thing. So from a technical perspective, it's just okay. We were going to it's like what would you say? It's an example. It's like, okay, we're doing work in parallel. You're preparing a video for the next TBC event, and you're going to split up the work of editing this part of the video, and then another person's going to edit another part, and then another person's going to edit another part. And while that might seem like you'll save time and get it done faster, the coordination of editing it in sync might be really difficult. Whereas maybe just splitting it up in terms of who's storing the data, or I don't know how to make that analogy work, but my point is we're simplifying that split. We're saying, you know what, we don't have to split up all of the resources that a node is supporting in a blockchain. We'll just split up the most important parts, which in the case of Ethereum is data. So, and Polkadot and Cosmos are still doing a fully sharded approach of just completely separate chains that are running in sequence with each other through a relay chain. And we'll see if that approach is successful. It's kind of like a more modular blockchain approach. And there's also a whole thing that I didn't even put in the slides of modular blockchains, which is to split up these components of blockchains that do, one part of the blockchain is transaction processing, the other part is data storage, the other part is consensus. You could split that up even more. And there's projects like Celestia that are trying to do that. We're not going to get into that. The point being, there's ways to split up work. Sharding is one of the big ones. Ethereum is doing a limited form of it called dank sharding. And these seem very promising. But in the case of Ethereum, we're likely still going to rely on rollups to do a lot of the scaling for us. And sharded blockchains still have some potential composability issues, or at the very least, a greater level of complexity. And the more complexity we have in our blockchain on the layer one, the higher the risks are.
So when it comes to sharding or dank sharding, now is that something that was like pre-programmed or allowed in on Ethereum, or is it something that somebody could do to Bitcoin as well?
So no, so it wasn't pre-programmed into Ethereum, although it's been discussed for many years. There is a plan to eventually upgrade Ethereum to sharding. In fact,
so this is like a side chain that's able to do this.
no, there is an intent to add this export. It is intended to upgrade Ethereum itself, the layer 1, so not a sidechain. So it would be native support, as opposed to a sidechain, which is
And because
separate.
it's centralized, they have that ability to do that.
Because what is?
Ethereum.
I wouldn't say it's centralized. It's it is doing more
centralized is
changes.
the wrong word.
Yeah.
But like in Bitcoin, you're not changing anything.
Yeah, I would say Ethereum is less. I mean, you could say it's more centralized in the sense that the developers are more active in making changes, but there's still a lot of consensus that you need to reach among the developers to make those changes. Whereas Bitcoin is much more hesitant to make changes. Again, the last change it made was Taproot, which took, it was like 5 or 6 years since its last. There's actually a good quote that came from Vitalik in a recent talk he did, where he was like, Bitcoiners usually think of Bitcoin as 80% complete. Ethereum, people think of Ethereum as like 40% complete. So from an Ethereum perspective, we're still early in our growth and development. So you have a bit more centralization by the fact that developers are still making these changes to get it to the point where it's fully ready for the big time and scaling and stuff like that.
And then remind me, because it's been a minute since we've talked, like the last time Bitcoin had a major change, a lot of people wanted to change, a lot of people didn't, and that's why you have like Bitcoin Cash?
Yes, that was the block size wars of, do we increase the block size for scalability, actually, or not? And the not version 1, which was to say, we'll use SegWit to try to improve and optimize for adding more transactions to a Bitcoin block, but we're not going to increase the size of the block because we don't want bigger nodes. So yeah, that was a contentious fork that happened as a result. And that's one of the reasons I think Bitcoin is hesitant to make changes, because it doesn't want to create those conditions for a fork again. But it's also just because a lot of Bitcoiners see Bitcoin as already very close to that end state of good enough. Some people think it's great as it is. Some people think it's great except for a few small tweaks that they might make in the future. Yeah.
From my limited interaction with the overall community, I don't see Bitcoin changing ever.
Yeah,
like any
I don't
upgrades or anything.
I don't think it's going to.
I don't think the community would allow it.
Yeah, I don't think it will have any major changes. Like Taproot was a recent change. That was a good improvement to a lot of things, but it's not
on Bitcoin.
Yeah, on Bitcoin.
Really?
Yes.
Okay.
Yeah. Yeah. No. It was
well, then I stand corrected.
But it took a while. I mean, it took years. I mean, it was ready like probably a year or two before that, and then even then, they took a long time to signal support. They waited until 90% of the miners were signaling support before they even scheduled a date to then have all the nodes in sync upgrade to that new protocol. And even then, it was not like a very, I would say, it wasn't a radical update. It's not as radical as the changes Ethereum is trying to make, because Ethereum is actually planning to move to proof of stake soon, scheduled now for September, tentatively. We'll see what happens.
But they've been doing that for like a year and a half?
They have been pushing it back for a year and a half because they want to do it very safely, because someone described moving from proof of work to proof of stake as trying to change the wheels on your car as you drive it. I have watched this kind of intently because I work in Ethereum, so I want to make sure that the thing that I'm working on does not blow up. And they've been doing a good job of doing several test runs with live networks to ensure that it does well. And they even have more test runs planned before then. And so usually it gets pushed back because there's something they want to, some protections that they want to build in, or they want to do some more testing. It's been just very careful, because when we do this, there's no going back. So once they do that, the intention of actually a proof of stake, people talk about energy usage and mining and stuff like that, and some people care about that. But the real reason that Ethereum moves to proof of stake is not for the climate. That's not the main reason. The main reason is because it enables sharding. You can't do sharding with proof of work because you don't know who the next block producer is going to be. It's totally random. So you can't really coordinate how do we split up the work. Whereas with proof of stake, you have validators that are staking. They do have to be online for a good amount of time. There is still some resistance to nodes going offline and stuff like that, but you can kind of schedule times for like, okay, you do this work, you do that work, and you can't just go offline randomly, although you still have redundancy if someone does. So you'll penalize people for doing that, basically. But because you do have some guarantees of nodes being online and being able to coordinate work, you can now enable things like sharding. So that is why we're moving. And that's a big contentious thing because some Bitcoiners are like, Ethereum people are trying to hate Bitcoin because it's killing the environment or stuff like that. And we at the TBC talk a lot about where Bitcoin can actually enable some good in creating more climate neutral mining and tap into new energy markets. So I would say like the perspective for a lot of people the thing to understand about Ethereum's roadmap is it's not about, proof of work is bad. It is proof of stake is better for what we're trying to do. Mm-hmm. And frankly, I think I know a lot of people, including Vitalik, have said they're happy to see Bitcoin continue to do proof of work because, proof of stake is riskier. What Ethereum is doing here is riskier. It's riskier simply because it's introducing new changes. So having Bitcoin as this is the the rock upon which you can count on your money being safe is good to have because it kind of gives Ethereum well, I wouldn't say it gives Ethereum permission to do anything, but it does make me more comfortable knowing I can own some Bitcoin and own some Ethereum, and there's always going to be a crypto I can count on at the end of the day that is just there for moving money around. And that the long-term vision of Ethereum for being more smart contract enabled is not held back by feeling like it can't make rapid changes. And I would say rapid is still relative. It's still taking its time with these changes, clearly, with proof of stake. But it is a development community where changes are happening more frequently than they are with Bitcoin because the vision is, more focused on smart contracts and complexity that Bitcoin doesn't feel it has to worry about as much. So yeah, there's a lot more to unpack there, but that is generally to say like that's why proof of stake is a thing for Ethereum, and it's going to be curious to see how this all plays out because this is still years in the making. Even when proof of stake happens, the sharding has to come after. So takeaways. So again, this is a bit Ethereum focused because I work in the space, but I would say my takeaway is Bitcoin and Ethereum are still dominant right now, like in their respective fields. Bitcoin is dominating the money game. Ethereum is dominating the smart contract game.
Right.
And that's really where they are doing best. People like to go out and say, well, Bitcoin has smart contracts. And I'd say, well, probably on a sidechain that I wouldn't trust, or at least that I wouldn't consider the same as Ethereum. But I would also go to people on Ethereum saying, well, Ethereum is clearly the best money. And I'd say, I don't know. I mean, maybe for you based on what you like in money, but a lot of people trust Bitcoin because it's simple, 21 million. They can rely on the security of a large mining network. So like I would say they are both doing great at what they set out to do, which is to be a safe store of value for Bitcoin and a safe place to run smart contracts for Ethereum. With Bitcoin, it still has the highest market cap, and it doesn't offer native smart contract support, and it likely won't for a long time. If it ever does, I would be very surprised, but right now it's kind of a view of like, Bitcoin is good at money and we should stick to that. It currently relies really on payment channels like Lightning to help solve the scalability problem, to really take a lot of transactions off-chain and really grow the payment use case of Bitcoin. And it's also kind of pointing to sidechains like Stacks and Liquid and Rootstock to make up for protocol limitations on smart contracts. Just say, well, if you want to do smart contracts with Bitcoin, use these sidechains. Now, again, you will see sidechains like Stacks say, well, we're perfectly secure. We borrow the security of Bitcoin. You would have a long, contentious debate on Twitter, and I've seen many other people have long, contentious debates on Twitter about this. I do not believe that is the case. That's my take. People watching this might disagree based on what they've heard from Stacks and Rootstock and others. You're not getting the same level of security. It's a separate blockchain. You're relying on a bridge. You're relying on other things. It might still be fine. And again, if it's running many validators, it might still be secure enough, but it's not as secure as Bitcoin. That's always going to be my take on sidechains. Yeah.
Well, one thing about it is like infrastructure. And you here in Texas, we have these giant Bitcoin mining facilities. Mm-hmm. I'm sure there's similar facilities like that for Ethereum. I just haven't seen them.
Yeah. Well, and they're smaller because they're not doing ASICs; they're doing GPUs.
Right. Well, like I have some in my garage, like GPU miners for Ethereum.
Yep.
Unfortunately, they haven't really been on this summer because it's so hot and the electricity cost.
That's right. You're doing your part of the demand response grid.
Yeah. And I'm just lazy and haven't turned them back on. But no, I'm being responsible. Anyway, but my point to that is it's like it seems like if I was going to the currency conversation, like I see Bitcoin, I'm like, well, duh. But then when all the conversations with you and smart contracts and the technology and the technology side of things with Ethereum, well, that just, in my mind, just seems like you said, it's when you're talking about doing, oh, you could do that on Bitcoin too, but it's like, but you're not really going to do that.
Yeah.
So I don't know. I don't know what I'm trying to say.
Yeah, I would say it's like it's clear that Bitcoin has a core value that it's doing really well at, and I think if it gets to the point where it gets good at smart contracts, great. I just don't see that today, and I don't see it set up for that, at least not until we find a solution to make sidechains secure.
Yeah.
And maybe there is a solution out there that can be found and implemented, and maybe someone's even already working on it. But of the major sidechains we've seen today for Bitcoin, I just have not seen that. And so, really, if we change gears and focus on Ethereum, it has a massive amount of dominance in the smart contract market share, and that's with a lot of competition right now. And so if you look at this, this is like DeFi value lock. This is like DeFi activity. So right now, of all the chains out there, Ethereum still has like 63% of all that value. And even then, and this is like a chart I got from like a website called DeFi Llama, which is just tracking all of this. Some of these squares are like this right here, that's Polygon. So that's a side chain to Ethereum. And a few more of these are also like sidechains or rollups. So in reality, if we count sidechains and rollups, this is probably more like 70, 80% of DeFi activity is all on Ethereum as a network. So it's still dominating that game. And its long-term roadmap to scale is through these rollups and through dank sharding. It's going to, the kind of next phase of this is that proof of stake upgrade scheduled for late 2022, potentially September right now, but it could get pushed back a little bit more. I would not be surprised. I would put a little bit of money on it being in 2022 because I doubt it's going to go back that much further because it seems so close. But really the long-term future is there's still more to come after proof of stake. I mean, people are like, oh, when proof of stake comes, my gas fees are going to be cheaper. It's like, actually, no. That actually doesn't change the fee structure. It's going to be the same. We're just changing the consensus. But future upgrades that we can do now with proof of stake will start to reduce those gas fees, and rollups will also be the place we expect people to start doing more of that activity, because that's where they'll really be able to do fast thousands of transactions per second style stuff. And so the roadmap for Ethereum is we're doing over 100,000 transactions per second through rollups and dank sharding. So that's the ambitious roadmap. It's going to take probably several more years to get to that fully completed place, like 2024, 2025 maybe even. But it takes hard work. It's a hard thing to get all your scale and decentralization and security all in one package.
But in it, like a never-ending race, because 24, 2025, when you get to that point, assuming that I forgot the real words for it, but like general use, the adoption rate of that product, as it increases, it's increasing demand. So even if you hit those goals, by the time you hit those goals, you're going to need double more goals.
Yes. Well, yeah.
More usage.
And that's where that roll-up of roll-up idea comes in. So maybe you can not just have, Ethereum here and rollups here, but you might have sub-rollups or subcategories of those that can further branch out and scale. Create, essentially a greater hierarchy of court systems, as long as they can verifiably come back to Ethereum somewhere to get back to that true security and decentralization. That is potentially the roadmap to take. And so I think the other thing for Ethereum is it wants to get to a point where it's not changing so much. There's actually kind of a graph that also Vitalik was creating where he's like, here's Ethereum right now. We're like this, like all these changes. What we really want to get to is this. We want to come to the point where we are as simple as Bitcoin. We don't make as many radical changes. And maybe not simple in terms of the protocol might itself still be more complex, but we're not changing it as much. We need to give the developers, the core developers building this, a break at some point. And we want to let these features, settle. We want to make sure people get used to them. We don't want to keep, changing things. We want to make it so that roll-ups and layer 2s are where people can move fast and break things and do things that are rapid-paced and try new things and just build a protocol that is solid and provides this. So we got to do a little bit of extra work in the meantime to get to that point where we can enable them to do that with scale. But then it's no longer on the Ethereum protocol itself to do all those rapid activities. So that's like the long-term vision that we're hoping to get to. It's going to take a little extra work in the next couple of years to get there, but hopefully core devs will be able to take a long vacation once we're there. Or at the very least, yeah, they'll get to the point where maybe they make changes as frequently as Bitcoin do every few years, or even longer. We're eventually going to get to that perfect state as long as we can put the onus of reacting to rapid change on a different layer, and that's that's ideally what you like. It's kind of like you got your Constitution and you got Congress, and hopefully it's more functional than our Congress, but Congress can do things like pass laws on a regular basis, and the Constitution is that thing you don't change very often.
Got it.
So, so yeah, that's where Ethereum's heading. And so for all these other DLTs, they're all trying to do new things. They're trying new designs. They're trying to improve adoption. But usually, in most cases, there is a trade-off. That going back to that trilemma where some decentralization or security is being given up for scale. In different forms and different factors. To some people, it might not seem like a trade-off. They're like, this is still decentralized, or this is still secure based on their definitions. So, many of the protocols I've talked about, the people on those teams or the people that invest in those protocols would say, no, Michael's wrong. It's actually totally secure based on blah, blah, blah. It would be some definition. I am applying a definition that we are using in the Bitcoin and Ethereum world. And even between Bitcoin and Ethereum, there is contention between those definitions.
What's funny about that statement about somebody saying, no, right, Michael's wrong. In my head, I'm going, I am so far out of the loop of understanding what's going on that in my mind, there's not even a shred of thought that you could be wrong.
Because I appreciate that level of trust.
No, and maybe it's just I'm naive and be like, well, of course you're the expert. But I'm like, I would not even know where to begin to even question if you're wrong or right.
Well, and that's the problem is a lot of the debates around which of these is better, which of these is truly decentralized, usually come down to relying on a more authoritative source that seems to know what they're talking about, even some that don't, or some that will, I think, willfully ignore certain issues with their protocols.
Well, this will be on the internet, so obviously you're right.
Yeah, there you go. But that is the thing. Like, again, a lot of the protocols I've covered here where I've said, well, they kind of aren't that decentralized or that secure, they claim to say, no, we're way more secure or decentralized than Bitcoin or Ethereum by some definition. And maybe it's not to say that those definitions are like made up. Like, some of them might be valid by some metric. It means different things to different people because we're not working off of like super specific definitions when we talk about security or decentralization. But to me, I've defined them as what we kind of expect out of Bitcoin and Ethereum. I've defined them in prior talks as well. So really, when it comes down to it, it's just there are always trade-offs. We're trying to squeeze as much as we can out of out of blockchains. And the more we squeeze in one direction, the more it kind of pops out the other. It's getting the trade-offs are transferred somewhere. So to me, like the best bet is to try to, and even Rollups, or rather Ethereum's new roadmap is, yes, we can, I think, achieve the vision of security, decentralization, and scalability, but there will be some trade-offs inherent in the fact that it might be a bit more of a complex protocol. It might rely more on rollups that aren't part of the protocol. It might rely on other things that weren't really initially considered to be ideal, but it's the trade-offs we've decided get us there the best way. So we'll see. And the thing I like to also say, as I would say, I don't consider myself an Ethereum or a Bitcoin maximalist, but I might say I'm somewhat of an EVM maximalist. And that is to say, even a lot of the protocols out there that are standalone, like Avalanche and Phantom, and even Hedera, I say all the DAGs, but there's all other non-DAGs, like Binance Chain, for example. They're building their own protocols and they're trying to be faster, but they're still using the EVM. They're still running essentially a version of Ethereum on this protocol.
What's EVM?
So the EVM is actually the virtual machine that runs the Solidity smart contracts.
Okay.
So they're basically forking Ethereum. They're saying, we're going to take this smart contract framework that Ethereum has built out, we're going to use it in our protocol, because building that from scratch is really tough. Only a few, like Polkadot and Solana and Cosmos, are trying to build out their own. And it also means learning a lot from scratch. Like, you learned smart contracts on Ethereum, well, back to basics. Now you're going to relearn it in a new language, in a new framework, with new security issues that are going to have to be learned the hard way. Whereas with Ethereum, speaking as someone working at a security company for Ethereum, we've learned a lot of those hard lessons already and enshrined them in, like, for example, the Open Zeppelin contract library that you can use not just on Ethereum mainnet, but on Rollups, on Sidechains, on these other L1s that support the EVM. We have a partnership with Hedera right now. We're working with them to help support our security products and tooling and libraries on their protocol that has Ethereum support. Or I should say EVM support. So it's just Ethereum virtual machine. That just means it runs Ethereum smart contracts. And the fact that it's supporting that, I think, says a lot about Ethereum. It says a lot about the fact that the developer community and libraries and tooling are mature enough that everyone wants a piece of that. Because building it from scratch is just really tough. I think only Solana and a few others are really trying to do a good job of building their own from scratch. But even then, it's difficult. We've seen several hacks on Solana as a result of security issues that come up, or the code just not being that mature. And it's the same thing Ethereum went through. We had the DAO hack in 2017 because people just didn't know how to write this properly. So that is to say, I think even if there are, my prediction is that the EVM is probably going to continue to be where we build smart contracts regardless. I mean, even Rootstock, which is a sidechain of Bitcoin, is running the EVM for supporting Ethereum smart contracts. So it's going to be an interesting world. That's why I say don't feel bad about learning Solidity if you feel like, oh, there's going to be another protocol out there that'll be better than Ethereum and beat it, and then I'm going to have to relearn a new framework. I bet more than likely they're going to still support Solidity, or at least some form of it.
Right. Well, I mean, when it comes to programming, like my best friend growing up, he learned Python, C++, and then by the time he's gotten in his 20s and 30s and now 40s, he's learned every new language that comes out. And the benefit of that is the benefit of the era of when he grew up programming was when he first started, there was like 2 languages, and now there's like 1 billion languages. So the same thing with this. The value is you learn Solidity, and yeah, I'm sure there's going to be other programs and other languages that come about, but they're usually going to be derivatives of the first one.
Yes, in a lot of cases. I don't know if it's always going to be the case with Solidity, but there's definitely going to be practices learned from Ethereum that will be used in other protocols, I'm sure, that we've seen already.
Yeah.
But it's like, I think Solidity reminds me the most of JavaScript, and both the good and the bad. That is to say, JavaScript was kind of like this thing that was kind of hastily put together in the 90s to support like some really basic web apps that people wanted a widget in their website. They wanted a drop-down menu. They wanted a cat to dance on screen, whatever it was. And then slowly, because JavaScript was kind of the first thing supported in the browser, more and more people were building on JavaScript, and people were like, well, is this the best language to use for this? It kind of has all these weird quirks, all these things that are not great. Security issues as well that were built into it. That is to say, just ways that you could use it improperly very easily. But over time, it was like, anyone who tried to build something better than JavaScript just struggled getting adoption because everyone was already using JavaScript. There was so much tooling on it, so many web apps. It's like rebuilding everything from scratch. And then also going to Stack Overflow to troubleshoot problems. Like the most problems people had were JavaScript, so you had the most resources to learn how to do it properly. So, and over time, JavaScript matured. It went from being a really janky language to only a slightly janky language today. That does actually have some nice features. It has things like TypeScript that are supposed to make it safer to use. It's now running in backend code, which no one predicted, but here we are. So that I say all of that to say that Solidity has a lot of the same properties of people have problems with it as a language. People think there were better ways to build it, that there are security issues with the way it's designed. But over time, people are learning to use it properly. We at Open Zeppelin are doing a lot of that. And it has become a standard. We worked with a bank called ANZ, an Australian bank that was launching a stablecoin, and they used the Solidity contracts we had written because they were they'd been around forever. There was the same things that USDC is using. And so they're like, yeah, well, it works, and it's secure, and we can get it audited easily by professionals that know Solidity. So that was a lot of the advantages that came out, and that's why I see a big future for Solidity. We will see. But yeah, I think both Bitcoin and Ethereum will continue to likely dominate, but we'll see if anyone can do it better. It's going to be, we're still early, honestly. It's going to be wild to see how things play out.
I'm glad you made it back in the studio. I look forward to hopefully doing more of these. Hopefully we can get back to doing them at least monthly, but hopefully maybe even bi-weekly or even weekly. Because I know my journey in this space, with the first 6 episodes we did, I got a front row seat to learning the ins and outs, because I think you go on crypto Twitter, and I learned that since last time. You get on YouTube. I think too many people focus on, especially with Bitcoin, they focus on the finance side of things and the currency side of things, without really getting into the deep dives of the behind the scenes of the technology Like today, we were talking about takeaways. My biggest takeaway from today is realizing that all these altcoins aren't their own standalone thing. They're maybe some of them are built upon. There's side chains on top of like the layer 2, the layer 1, and like those are concepts I didn't even know existed.
Yep. Yeah.
So
it's going to be a wild
that's what I
ecosystem.
learned, and that might be the most basic thing that has been discussed today. But you know what? That's my takeaway.
I mean, that's useful to know. So now you're like, oh, well, this is yeah. I mean, honestly, knowing what a sidechain is and also knowing it's not going to borrow security from the mainnet unless it's got some new like black magic no one knows about. Yeah.
So at my next dinner party, when somebody talks about, hey, have you heard about blah, blah, I'm like, is that a layer 1 or layer 2?
Yeah, there
They're
you
going to be like, shut up.
Okay.
All
All
right.
right. Good to be back.
Well, yeah, and if you enjoyed watching this, make sure you subscribe, you like the channel. Check out texasblockchaincouncil.org. Also, check out texasblockchainsummit.org. That's our annual event down in Austin, where we have policymakers and influencers within the blockchain Bitcoin space. And it's a little higher level discussion about blockchain technology. So definitely check that out. Again, thank you so much for tuning in. Drop your questions in the comment section. If you do have questions, we can connect you with Michael, but also we can just answer them in the comments. So, anything else for you?
If you work for a sidechain project, I'm sorry, I just don't like sidechains. Someone from Stacks is going to be probably mad at me at some point saying they're not a sidechain. You're a sidechain, and like hopefully that doesn't turn into a comment fight. But you know, I just had to. I have to set that up.
Conflict is engagement. So, engagement's engagement.
Yep.
Anyway.
Oh, and we will have a smart contract panel at the summit, which will be much higher level, I think, than what we're discussing now. But to say, okay, for policymakers, where do smart contracts apply?
Awesome.
Which should be fun.
Well, again, thanks you, whatever. Thank you. We'll see you next time. Jeez, my brain hurts again. I forgot how intense these are for me, at least.
Yes.
Just because I'm like, huh?